So, welcome to Innovation Guelph Presents Toolkit Tuesday. Today's session is called Startup Founders, the Road to Getting Paid. Are you a founder of an early stage company looking to start paying yourself for all of your hard work? We know that this is a lot of hard work, but paying yourself may not be as simple as writing yourself a check. So, knowing when the right time to begin paying yourself and what options are available to you as a founder is not always clear. Ameer Abdulla and Chris Chipman are joining us here today from EY, from Ernst & Young, today to teach us about the options and considerations when deciding to compensate yourself as a founder of an early stage company. And Amir will share his insights in response to these following questions, but of course there'll be some time for Q&A at the end, so you can ask more questions. But questions like, when is the right time to pay myself as a founder? What compensation options are available? In addition to cash flow, what other considerations should be analyzed? What are the tax implications to the business and to me as a founder? And will my decision on how and how much I pay myself impact outside investors? So all really great questions for startups. Now, before I introduce Amir to you today, a little bit of housekeeping as usual. Today's session is being recorded and will be posted publicly on Innovation Guelph's YouTube channel. We ask that you turn off your mics for the presentation, and if you have any questions, you can type them in the chat box below, where Jordan will be monitoring the conversation and will pose your questions when the right moment to do so comes to light. And of course, during the last 30 minutes of today's session during our open Q&A time. To experience today's presentation in American Sign Language, please pin or spotlight the presenter, Amir, and both the interpreters, Kevin and Shannon, to the top of your gallery. In addition, anyone in the session today can access the Zoom closed caption function by clicking on the closed caption option on the bottom of your screen. And I guess just in case nobody here knows who I am Mickey Kempo. Hello, I am a program manager at Innovation Guelph, and I am also the manager of the Innovation Expo, which is happening this Thursday. A little plug, if you've not registered, please do. It is free to attend, and we would love to see you. I also want to take a quick second to thank all of our corporate sponsors. Absolutely a big thank you to Ernst & Young and to ISU Core, to Marexis, Miller Thompson, OKR Financial, Reese Informatica, Invest in Guelph, BDO. I'm so very, very grateful, we all are, for all of the support that you give us in everything that we do. So before I go too much further, I think you're all here to listen to Amir. So I'm going to just say thank you to Sleo for providing the ASL interpretation at all of our Toolkit Tuesdays. And we're going to quickly move into just a little bit of a bio on Amir. So Amir is the executive director of private tax at EY Canada. Amir has over 10 years of experience working in public accounting and currently focuses on corporate and personal tax planning. He provides tax advice to Canadian private companies and their shareholders, in addition to advising on reorgs, intergenerational transfers, purchase of sale, and businesses' estate planning. So Amir also has experience advising trusts, non-for-profits, and charities. All around, Amir's very experienced and will be wonderful talking to us today and helping the founders yourselves find a way to pay yourself, and what does that look like. So without talking too much more, thank you all for joining us. I'm going to pass things over to Chris and to Amir, and if at any time you have questions, just let us know, and Jordan will take care of that. Thank you so much.
Great, thanks, Mickey. And Jordan, thanks for all your help in getting ready for today. So good afternoon, everybody. On behalf of EY and Innovation Guelph, just wanted to thank everybody for joining us today. Despite the sunny weather outside, it's a pleasure that you could join us. I just wanted to take a minute to introduce myself before I pass things over to Amir for the formal content, I guess, of the Toolkit Tuesday. So my name is Chris Chipman. I'm a senior manager at EY, based in our Waterloo office. I live in Guelph, and I'm the primary contact for Innovation Guelph for EY. So my role, I work in what we call our business tax incentive group. And, for the past 22 years, I've supported companies in accessing various government funding programs, grants and incentive type programs, SHRED being a very important one that we deal with a lot, and other programs like IRAP. So I just wanted to take a minute to introduce myself. Should you have any questions for Amir or myself after the event, please feel free to reach out to me and I can coordinate with Amir. And so again, pleasure to meet everybody. And I guess with that, Amir, it's over to you.
Thank you very much, Chris. And good morning, good afternoon, everyone. I'm not sure exactly where everyone is connecting from in this virtual environment. It's always hard to tell, so I try to hedge my bets. So just to confirm, Nikki and Jordan, everyone can see my screen? Thumbs up? Perfect. Thank you very much. Always want to make sure these technical things work before we get started, or we might be on slide 15 and no one said a blessed thing because you're all so polite. So today we're going to be talking about the road to getting paid, and a number of those questions that Nikki alluded to earlier. We'll be covering all of those. And as we go through our presentation today, again, there's that chat functionality. You can ask questions. Jordan will be monitoring the chat, and I'll leave some spots to breathe. Certainly for me to take a breath, grab a sip of water. So there'll be some natural pauses as we go throughout our presentation today. And always there is a Q&A session at the end where we might invite you to come off mute and ask your question live. So our agenda today, again, likely following the structure that Nikki alluded to earlier, with asking some questions and answering those questions as we go through. I find that might be the most beneficial and fruitful for everyone. Feel free to, again, ask questions in the chat box, and happy to deviate a little bit in the Q&A if someone has a topic or a question where something that has been said sparks further question or further thoughts. Happy to discuss those at the end in the Q&A section. So first question: when is the right time to pay myself as a founder? Unfortunately, the answer is great and easy and could make a very short presentation, but as soon as possible, right away, the instant you can. And I know it's sometimes difficult, and it's a difficult thing to do, especially early stage. You are trying to get your idea off the ground and make a go of it, but as soon as possible. And you will thank yourself, your significant others will thank yourself, but also the business will thank you. It's often very difficult to think through or make the transition from I have an idea to running a business. But as soon as you can get in the habit of paying yourself because your cash flow permits it, or you've made the deliberate choice to do so, you've now made the jump from idea to business. And that is so critical, and it is so important. And practically, that's why we're all here. We are trying to make something, turning an idea into a commercially viable business. And so as soon as you have the cash flow to permit, do it. There is never a reason to not or to hold back. I think it, again, benefits yourself and also proves the concept your idea can make a run of it as a business. And so if we go through the points, again, it's critical to establish the value for your contributions as an employee. As you go through your journey from idea to startup to getting seed capital, series A, B, C, and then continuing to scale your business, it is critical to establish value. And one of those is as compensation. I tell this joke, and so I'll tell it now. Again, if you don't pay yourself for your time, then you're volunteering. But that means you're running a charity and not a business. And there's a separate presentation for that one. So don't necessarily sell yourself short is really the theme. So make sure you pay yourself. Now, how and how much and the implications, we'll talk about that on the upcoming slides. But this one is all about paying or getting in the right mindset to pay yourself as soon as you can. How much to be determined based on the push and pull of the business and your personal needs, but getting in the habit is so critical. And the sooner you get in the habit, the better, because once you establish the habit, then your lenders, your employees, your investors, yourself get in that habit of seeing that regular payment occur. So Jordan, my first polling question, what is the most tax efficient way to receive a $200,000 salary? So as that poll comes up, I want to bring that poll up, and as it's there, we'll be talking about, or I'll talk through the last points on my slide, and there are significant advantages when you pay yourself. And we'll allude to, or we'll get to some of the intricacies and oddities of our Canadian tax system a bit later, but I do want to put up that polling question and I can chat as it goes along here. And so again, the three options are 5 years. So again, we're talking about $200,000 in aggregate over the course of 5 years. So is it more tax efficient to get $40,000 for 5 years? Or is it more tax efficient to get 3 years of zero salary and 2 years at 100,000? Again, very common to not pay yourself for a period of time and then sort of catch up later. And then another option is 4 years of $0 salary and 1 year at 200,000. So again, a lot of catch up in that last year. A resource that I've posted, hopefully no one cheats right away, but there's a link at the bottom to EY tax calculators, and that's the most recent one for 2021. And so it's on your slide and you can access that at a later point in time, but that's that calculator gets updated every year with new tax rates and gets calibrated to every province as well. And so you can put in a salary, push the button, and it'll spit out what your expected taxes will be. So if someone's super keen, you can do that now. If not, I want to see what your gut feeling is. So Jordan, do I keep talking, or do you have the results for me?
I've shared those results there. Can you see them? Yes,
I can. So we've got 80% of folks think the first answer is correct. So 5 years at $40,000 salary. We have some folks who think the second option, so 3 years of zero salary and 2 years at $100,000 of salary. And then some folks who think the last option. So the vast majority think the first one is the most tax efficient. The correct answer is the first option. So 5 years at $40,000 of the salary. For perspective, the after-tax receipt over the course of 5 years for each of the three options, I'll tell you now, and you can see how interesting or odd our Canadian tax system is. So remember, we started with the same $200,000. The only thing we're changing is the frequency and time horizon for when those payments occur. So in option one, there will be about $173,000 of cash after you pay your taxes. All right, not so bad. Started with $200,000, ended with $173,000. Okay, option number two. If you did option number two, $0 of salary for 3 years and $100,000 for 2, then your after-tax cash would be $153,000. Okay. So to compare that to the first option was 173. So already we've got a bit of a win doing option one versus option two. Option three, again, $0 salary 4 years and 1 year at $200,000. Your after-tax take in option three would be $130,000. No, I did not do that wrong. 173, 153, 130. That is our Canadian progressive tax system. So there's a significant benefit to get in the habit of paying yourself. Even if it's a small number every year, there are significant tax advantages. We haven't even talked about the rest of the things, the rest of considerations, the other options. We're just talking salary, and we're only changing the frequency. And so it's critical to get in the habit of paying yourself. First breath. Jordan, don't know if you have any questions, but I'll advance the slide and we can get going on to the next topic.
Go ahead. There's nothing yet.
Okay.
We do actually just have a question now.
Okay.
Okay, so is it better to pay yourself a higher salary or to have a lower salary and a dividend?
Ooh, a blend. We will get to that. I'm not going to cut to the chase right now. We will get to that. I have an illustration later on. All right, so speaking of options then, so now we've committed to, and we've all committed to paying yourself an amount every year. The size and quantum and blend and type, we'll get to that, but we're committed to doing so. So options. Assuming, again, we can justify a regular form of compensation, I've listed the 5 most common on the slide here. We'll be going over the pros and cons on the next couple of slides. And I even have a couple of slides that will be diving much deeper into a couple of these options that often provide some significant tax savings, or where there have been some significant tax traps that I've seen people fall into. So I thought it'd be worth it spending 5 or 6 minutes on some topics in a bit more detail. So before I start with my information, hot off the polls, if we can have another one, Jordan, come up. This is which is the best form of compensation of the 5 you have here? All right, so the poll is up. Again, for 5 options, we have salary, we have dividends, we have stock options, we have short-term loans, and we have long-term loans. To clarify, short-term loan is a loan made by the organization or the corporation to the shareholder for a period of time less than 2 years, let's say. And a long-term loan is a loan made by the corporation to the individual for a period of greater than 2 years. And stock option is, well, we'll not get too cute here. It is a stock option, plain vanilla, as we usually see them in Canada. All right.
I've shared the results there for you.
Excellent, thank you. So the results are in, a bit more diverse this time compared to the last one. The first one was pretty much a landslide for the first option in terms of timing of payments. This one, about 60% of folks thought a salary was best, 25% thought a dividend was best, 15% stock options, and no takers on the loans, which is great because loans are where the most traps come in, but no takers on that one. The actual answer from a full bore, multifaceted perspective is it depends. So I am kind of glad there is a diversity in response, because there is a diversity in actual answer. There is a mathematical best form, and I'll show you that, and we'll go through an example of that a bit later on. But compensation is a multifaceted decision, and it requires a lot of different perspectives to get the optimal answer. I don't want to say perfect, and I don't want to say best, because there are going to be trade-offs every time, but there is certainly an optimal for every single organization and person. So I've put a number, all 5, on a chart with some pros and cons on there. We'll dive a bit deeper here, and then we'll go very deep into a couple of these options on the slides later. So I find this is a very handy chart to have. Sometimes folks, print things out and have cheat sheets. This is a good one to keep. And the salary, dividend, stock option, short-term loan, long-term loan, those are the 5 options. Because this is a multifaceted approach, because there are so many ways to mix and match compensation, already a question has come through of, well, what about a little salary and a little dividend, or big salary, small dividend, small salary, big dividend. There are so many different ways and combinations and permutations of compensation that, to simplify and boil things down for the purposes of this exercise, and for a lot of founders, I do the same thing, just think through. I try to match the compensation method to your role or to the objective that we're trying to achieve. And so that's the second column, is the purpose. So the options are on the far left. The purpose is what I use to articulate, well, this is a good opportunity to use that specific form of compensation, and then the pros and cons of each. And so for salary, I generally use the purpose of the salary is to reflect your contributions as an employee. Again, as a founder, as a startup founder, you wear so many hats, and we'll get to that later, but you wear so many hats. There are so many things running around in your minds, and so many important things that have to be done, that if you say salary is your contribution as an employee, because it's easy, you might have other employees, and so to pay everybody in the same manner is a good internal mechanism from an HR perspective. And that's the business perspective. It's good to have a salary for a number of other reasons. Chris will allude to that. We'll get to that later, in terms of there are incentive programs out there that specifically incentivize and reward salary and contributions by employees. And so those are the high level pros of a salary. The con is it's often the least tax efficient from a pure personal point of view. The second thing is a dividend, and I like to call it dividend, sale of shares, or bonuses. And I lump all these together, even though the mechanics are slightly different for each, because the purpose is the same. The purpose of these, the way I like to view them, is this values or rewards the growth of the business. So the salary represents your contributions as an employee as a compensation form, and then the growth of the business as the business grows, rewarding yourself or compensating yourself for that element is used generally for as a dividend, sale of share, or bonus. It is tax efficient. We have a number of tax credits and exemptions designed for these specific forms of compensation. So there's a dividend tax credit regime where if you receive a dividend, the individual gets a dividend tax credit, and that is a fixed number. So there's some benefits on that. There's also a lifetime capital gains exemption. So again, if you sell some of your shares, all of your shares of your Canadian business to a number of folks, so an investor on an exit or an IPO, there are these exemptions that exist. It's about $890,000 of exemption that exists right now. And that number continues to go up every year. And so I used to know when it was one number and it stayed that way for a long time, but it keeps changing on me every 12 months. Tricky how it happens. But that's about the number now. It's 890. And again, it'll go up on January 1st of this year, of next year again. And again, those are designed to incentivize and reward growth from a tax policy perspective. The con for that is, again, it's cash flow or externally dependent. You can't necessarily engineer a sale of some of your shares to a third party just because you feel like compensating yourself for the growth of your business. Some of those are discrete events. And same thing for a dividend, those are cash flow dependent. Stock options, the purpose of those I like to articulate as a form of equity compensation. So not cash compensation, equity compensation. And I like to separate those two. I know a lot of HR and payroll groups will combine and say, well, your total compensation package for tax purposes and thinking through it, I pull them apart. The benefit is it is non-cash compensation. So there is far fewer restrictions on your cash flow, and so it might be a very flexible form of compensation that you can use. And there are some tax advantages that are possible with stock options. We'll dig a bit deeper into those a bit later on. But there are some cons. And so tax implications for founders, it's not advantageous. There are actually some rules that limit the tax benefits for founders of stock options. And the other obvious one is it's dilutive. And so the more stock options you have, the fewer shares you have of your business, the smaller your percentage is. So that's something to consider. Again, not necessarily a tax thing, but it is an element of that decision-making process. Short-term loan, again, the purpose of that is an employee benefit. It's very easy to do. Here's a loan, I want the money back. The con for tax purposes, it must be repaid within a year or there are significant tax consequences. And so I'm very glad no one on our poll identified that a short-term loan is the best form of compensation because it is the most inefficiently taxed thing in Canada. So I'm glad no one went that way. And so I'll stop talking about that now. Long-term loan, employee benefits. There are some non-taxable forms of compensation that you can do for a long-term loan. The con is that's very limited in scope, but for example, if folks take a loan out from their company to buy shares of the company, buy a home, buy a vehicle, those things are actually non-taxable forms of comp that can be accessed under certain circumstances. So I put that on there because it's often good to round out your total compensation plan. Pause on that one. Any questions? And then I'll start diving deeper now into each compensation option and some practical considerations to think through. Before I get to that, any questions that have come up?
Yep, we do have one question. So in the chat, we can get shred refund if we pay salary, correct?
Correct. Hopefully, Chris, I didn't steal your thunder, but that's absolutely.
That's good. I just thought we could maybe park a little more discussion on that. I know that's going to come up later. So thanks for the question, Azizer. We'll address that for sure in a few slides.
Yeah. Very good. Okay. Anything else, or? Okay. So let's dive a bit deeper into salary and bonus. So The practical considerations. So we articulated on the last slide that salary is pretty easy to do. It's often, it's not as easy as just writing yourself a check. There are a number of things that have to happen to make sure that it's done properly, you're compliant with the various laws and regulations that we have. And I've put on this slide my gotcha list of things that I've seen people fall into, or some traps that I've seen where people think through paying themselves a salary or bonus for the first time. Generally, you work through all the kinks as you go through the process, but this is my list. And so some of them may or may not be applicable to your specific situation at this point in time, but I find this is another good cheat sheet to keep kind of in your HR payroll file. So timelines and due dates, if there is a payment of salary or bonus or some form of employment compensation, if there is a payment in a month, then your remittance, so I'm talking about Canada Pension Plan, employment insurance or EI, and income tax, there's a mandatory withholding for each of those three. Those are due the 15th of the month following the month of payment. So for example, if paid a salary today, then your remittances of Canada Pension Plan, EI, and income tax are due to Canada Revenue by November 15th. In addition, there's an annual reporting that you have to navigate through. And that annual reporting is due by February of the year following payment. So using the same salary paid today, then there's a T4 that, normal T4s that are due to Canada Revenue and the recipient by February 29th, 2022. So that's something to keep in mind of when you are doing a salary. It's not just as simple as writing a check. You have to think of payroll remittances and you have to think of government filings. I guess one thing I didn't put on here is make sure you have a payroll account open at Canada Revenue. So when you open your business, you have a business number. There are separate accounts. There's an income tax account, there's a GST account, and a payroll account. And not all of them are open by default. So before you go and pay yourself a salary or a bonus, make sure your payroll account is open. In addition, your payroll remittances, so your T4s and those sorts of things, may have to be e-filed if you have a certain number, and that number kind of moves around. Certainly these days during COVID, the number was dropped very low, almost to, I think, any like if you had more than 10 T4s, you had to e-file. Canada Revenue was not interested in processing paper T4s. So there are federal withholding taxes to keep in mind. So there's federal income tax, Canada Pension Plan, and EI. There are tables and charts on the Canada Revenue website that will tell you exactly how much to do, so they make it really easy. And there's even a calculator on the Canada Revenue website where you type in exactly how much you're going to get paid, the frequency, so once a month, every 2 weeks, whatever, and it'll tell you exactly what you need to do, so they make it as easy as possible for you. And then there are also provincial withholding taxes. So there's provincial income tax. So in Ontario, our taxes federally and provincially are harmonized, but if you are in a non-harmonized province like Quebec or Alberta, then those provinces have separate provincial taxes that have to be remitted. Also keep in mind, there's workers' compensation premiums or an employer health tax. So those are things to keep in mind when you are doing these sorts of payments. Now, I didn't want to scare you by listing all of these things that have to happen. I just want to let you know they exist. And don't let all of these mechanics get in the way of achieving your goal of regular compensation. You will eventually or already have employees, and you'll have to work through these mechanics at some point. And so I find it actually much better to sort of work out the bugs in your system or processes before you have 2 or 3 or 4 employees where you have to do all these things on a very regular basis. So it's always good to work through these yourself, but there are many other bookkeepers or payroll providers out there who are able to assist. So you're not on this alone. And finally, I bring this one up, local or contractual payments, depending on your organization, your investors, where you are in your business. There are some regulatory or contractual payments. So if there's a matching for pensions, if there is an earnout for, let's say, an employee who has been terminated or left, or if there's severance for an employee that you're terminating. those are contractual payments that you have to abide by and do the withholdings for. So those are all the gotchas I've accumulated throughout my career on salary and bonus. Again, if you have any more questions, put them in the chat, or we can tackle them at the end. Now I'm going to move on to dividends, just to keep us moving here. So this slide, don't let it betray you. There's a lot of information on here. And I've arranged it in a chart form to, again, be a resource that you can leverage and use in the future, or even now if it's applicable. I usually see a lot of these distinctions change as a company grows and scales and now needs to, understand or appreciate, hey, dividend? You're telling me there's 3 different kinds in Canada? Huh, well, what does that mean? And what does it mean to me? And so I put them all on the screen, on the slide. I'll go through them and we can dive a bit deeper into them if we need to, but I don't want to spend a whole lot of time on this slide. The 3 types of dividends, when people think of a dividend, they actually think of the first kind in this row, and that's just a taxable or a normal dividend. Again, I've used the rates applicable for an Ontario resident. The personal tax rate is about 49%, and that's the top marginal tax rate for an individual in Ontario. And so from the corporate reporting side, there's a special slip you have to fill out when you pay a taxable dividend. It's a T5. And there is a refundable component of this tax, and the refund comes out of the non-eligible refundable dividend tax on hand account, or NERDTO. And there is withholding tax on this type of payment if you pay to a non-resident. So again, it's a good cheat sheet to have. Some of that may or may not have been applicable, but I did want to give this information. There's another type of dividend. It's called an eligible dividend. The tax rate on that is a bit lower. It's 38%. The reporting is still a T5. There is refundable tax associated with this. It's called and it comes from the eligible refundable dividend tax on hand account, or ERDTO. And again, if you pay this type of dividend to a non-resident, there is withholding tax. Finally, and this is the one where most people get excited, there's a capital dividend, and it exists. In Canada, the personal tax rate on a capital dividend is 0%. No, that's true. There's no typo. It's 0. It is tax-free, and so people get really excited by it because they want it and they want to figure out how do they get it. We can go over that in more detail a bit later, but I wanted to let you know for this slide, it exists. Because it is a 0% tax rate, the reporting is different. It's a separate form. It's a much bigger form, a T2057. It doesn't have refundable tax associated with it, nor does it have withholding tax. So those are the 3 types of dividends that exist in Canada. Most of the time, we talk about that first category, a taxable dividend. You have to do something special to get an eligible dividend, and you also have to do something very special to have a capital dividend. It's not like I can wave my magic wand and make your dividends all capital. So that's something to have, and you can use as a resource later. The other type of dividend gotcha that I see is this Part 6.1 tax. And basically, it's an anti-avoidance rule for hybrid instruments. So this is something that is debt, but disguised as equity. And I bring it up in these formats because so many of the investors or angels or even founders use these types of investments in their company. And that's great. It's a great financing source. It's, looks like debt, but it actually is a preferred share or some sort of equity. But be aware that if you pay a dividend on this kind of share, then there is likely a corporate tax of 40% when you pay a dividend above an annual limit. And that limit right now is about $500,000. It could change, but it's something to keep in mind when you have these sort of preferred shares outstanding. It's caught a number of people by surprise if they have these preferred shares. They do a dividend to their founders, their investors, their angels, and oops, there's now a tax associated. And you can see that it's a 40% tax, so it is quite punitive. So wanted to bring that out just in case people had those types of shares outstanding, or had that kind of investment, or even contemplating issuing that type of investment, just be aware. That's my pause on dividends and the gotchas I've seen there. Moving now to stock options. And I start with independent contractors, and I've got a slide on stock options for employees coming up right after. And again, these are the things that catch people. So as an independent contractor, a stock option is equity compensation. It is still compensation nonetheless. Therefore, it's likely taxable to the contractor. Again, it's a thing. People think it's tax-free. It often is not when there's an independent contractor arrangement. And so something to keep in mind when you are out negotiating with vendors, or you're looking at potential investors, or you're even trying to court, let's say, part-time CFO or something to that effect, keep this in mind, as there might be some negative tax consequences. And so again, this is the cheat sheet. Again, it's generally, when these stock options are granted, generally characterized as business income to the recipient. And there are very few deductions that the recipient can take against them. When they exercise the option, any increase in the value is included as income. And so at the time of the exercise, so that could be a bit unfortunate if they exercise, but there's no corresponding liquidity event. And so they now have a tax liability, and they have to self-fund that tax liability. Don't necessarily want to give tax advice here, but again, that increase in value could be business income or capital gains. That's something for the contractor to decide, and their tax advisor to make that determination on. Counsel all the founders on the call to not give your contractors their tax advice. Let them do that themselves. And keep in mind that if they have an income inclusion, it is subject to GST or HST. Again, not necessarily something the founder needs to know, but you need to be aware of it, that as you're negotiating for amounts and prices and those sorts of things, this is something on the mind of the other side. And there are also some regulations that have to be followed. Regulation 105, there's withholding tax for services provided in Canada by a non-resident. That's something to consider. And again, it's not uncommon to, especially in this day and age, to have someone who's not in Canada help you out or provide services. And so they would have to, so there are some home country tax considerations where the services are provided elsewhere. So that's what I have for stock options. Now I'll talk about employees. So this is the one, or this is the category where people are very familiar with and very comfortable with, or at least the internet is and Google is. And so hopefully to not necessarily demystify everything, but try to set the record straight. So at grant, there are generally no Canadian tax consequences to Canadian employees when they're granted a stock option of a Canadian company. That's great. That's very helpful. At exercise, so when someone says, hey, look, I have a stock option, turn it into a share. There's a taxable employment benefit. That's fine. That employment benefit is computed and locked in at that date. And so it's computed as the difference between the fair market value of the share that I received minus the strike price or exercise price that I paid. Okay, that's good. If the issuing company is a Canadian controlled private company corporation or a CCPC, that taxable benefit, which has been locked in, gets deferred until the year the employee actually sells the shares. And that's helpful because you've now got taxable income, but you don't have to pay tax on it until later. It's good. That's a benefit that exists. And a third benefit that could exist is the employee may be eligible for a stock option deduction. So again, at kind of point 2, there's a benefit that's computed and it's locked in. Point 3, you might be able to get a reduction. That's very helpful. Now, how do you get this reduction? Because really that's the secret sauce and that's the magic. Well, one condition, and it's an or, the time the option was granted, the exercise or strike price was not less than the fair market value of the shares. So what that means is the options were not issued in the money. It's fairly common. So if your share price is $2 a share, you issue the option at $2 a share, you're okay. You would meet that first condition. The alternative is if the company is a Canadian-controlled private corporation, then the employee just has to own the share for at least 2 years. So sometimes we see that for founders, where they issue themselves, 1,000 or 1,000,000 options at 0.000001 cent per option. To be argued if that's in the money or not, but if they hold the shares for 2 years, then they would also benefit from that 50% stock option deduction. So those are the things to keep in mind when you're looking at equity compensation and grants of stock options. 2 things that I didn't put on the slide, and I forgot, Jordan, I should have made a polling question of this, but here we go. The question usually is, are board members employees or are they independent contractors? Which slide do they fall into? The answer is they're employees. For all purposes of the Income Tax Act, board members are employees. So they would generally fall under this slide and the treatment therein. Founders are founders' employees. And I've been using that term interchangeably so far. And generally speaking, especially early stage companies, founders do not get these tax benefits. They're actually independent contractors. And that's something that catches a lot of people and causes a lot of problems. There's a rule somewhere in my Income Tax Act that says if a founder is related to the company, meaning if they control more than 50% of the company, they'll be treated as an independent contractor and not an employee. And so that's something, again, this group could perhaps make note of that, keep it in your back pocket, because there are a lot of circumstances where founders may grant a bunch of stock options themselves, or their family, or their parents, and they may end up in a situation where they're thinking they're going to get all the tax benefits on this slide. So deferral of benefit, 50% stock option deduction, employment income, all those things, whereas they're actually stuck on the independent contractor. So taxation right away, full rate of tax, no 50% stock option deduction. So had to bring that up. I could not let a discussion with founders go without me mentioning that, because it has caught a number of people, and if no one else gets caught by that, I have done my job. So that's all I have on that second question of all the different types of compensation, the options, pros and cons, and I did a bit of a deeper dive on a number of them. Jordan, any questions before we move on?
We're all caught up for now, but I do encourage everyone to post them in the chat if you do have questions.
All right. So now we've talked about options, pros and cons, let you know about some tax traps and some general traps. So you have some resources that you can put in your file. Things to think about that are non-tax. Because we will get to tax, I swear. We will get to the tax and the math later on, but I didn't want that to dominate the conversation. I really wanted the fact that it's a multifaceted decision to take center stage here. Because it's multifaceted, there is no one-size-fits-all answer at any given point in time for any given organization. Because as a founder, you wear multiple hats. You have an employee hat. You have a vendor hat because you are selling your time and services to the company. You're a CEO, you're a shareholder, you're a board member. And there are probably a number of other hats that you wear that I didn't put on the slide, but these 5 are the most common ones, especially early stage startups. You wear all of these hats, and each of those perspectives will have different goals and constraints associated with what that role requires. So if you just had a board member hat on, there's certain set of things you would do with respect to compensation and the type of compensation and how much and the format, because you'd be concerned about business growth and business risk. Whereas a CEO, you would be most interested with business growth. As an employee, you're probably interested in paying your mortgage. As a shareholder, you're probably interested in growing your investment. And all of those different perspectives commingle and intertwine and makes the optimal answer different. And your dominant perspective, because one human can have all these hats, but your dominant perspective will change as the business matures. That's fairly common. As a startup, before you even have angel funding, you're probably have the CEO hat on, and all you're looking at is turning your idea into a business. And then as you get seed funding and as you're growing, then perhaps your employee or vendor or board member hat takes most precedence. And then as your company really scales and grows, your shareholder hat takes highest precedence because you're looking at value creation. And maybe even you step away from the employee or CEO hat. You may just say, you know what, I want to step away from this business entirely because I like the idea part, I like the technology part, I don't like the business running part. And so you might, give that role up. And so your hat will be your hat will be chosen by yourself to be very different than when it was when you started. And so there's multiple perspectives to consider when just considering the type and quantum of your compensation. One thing I always articulate just as an example, in addition to the ones I've given, is if I'm an employee versus a shareholder. Well, if I'm an employee, generally you'd want to increase your personal compensation. You want to raise, you want to be able to pay your mortgage, pay your car, pay your bills, go to the grocery store, go out for a nice dinner. Those things all require increased compensation. Whereas from a shareholder perspective, you don't want that. You want all that value to stay in the business, grow the business, grow the value of the shares, grow the overall value of the business, and that will create greater corporate value. So it's not necessarily a zero-sum game, but it could be. And a number of founders think it is a zero-sum game. And I want to articulate that it's not always, and often not. There are tax incentives and things we'll go over later that make it, there's an optimal solution to achieve the best balance. So again, articulating some of the dichotomies and the pushing and pulling that exists, things to think about from both a personal and corporate perspective. Payroll programs, they're expensive. CPP, EI, and EHT. If you do salary, then there's a portion of CPP, EI that the employee has to remit and withhold and remit from their paycheck, but also the company has to pay a matching component as well. And so there's an additional cost to salary that exists when you have salary and those compensation programs. On the flip side, as an employee, it might be nice to be contributing to the CPP program or the EI program in case you may be looking to leverage or benefit from those programs down the road. So there's that push and pull and that balancing act that you have to have. Also retirement programs. Again, an RRSP or a pension program. Salary from a company would generally give the employee RRSP contribution room. Well, that's a benefit that exists, and so it might be worth it for the company to pay a salary, and yeah, you got CPP and EI to pay, but your employee might be better off because they now have the ability to access an RRSP plan, whereas a dividend would not give that benefit. And also you have to balance your cash needs from both the personal and corporate. And if you wear both hats, it's fairly easy to, it's easy to articulate the push and pull, very difficult to identify, well, what is the right number for compensation? From a pure personal side, again, you take off all the other hats except the employee hat. What's important? Well, there might be options to split income with your spouse or family, and so taking a salary or some other compensation might be very beneficial. If you have other sources of income, might influence how much personal compensation you take from the company if you have other sources of income. Is there a benefit for you to defer or reinvest your investment proceeds? So if you receive a dividend, let's say from the company, there might be an ability to not pay tax on that right away, but to reinvest it in another vehicle. And also if you have another structure, so if you have a holding company or a trust or other tax efficient structuring at your disposal, those might be elements to consider when you're deciding, well, how much of a number, how much compensation should you take? On the next slide, we've got some corporate elements to think about. Well, from a corporation, do I pay my people and how? And things to think about are some tax incentives and lending requirements and working capital needs and capital expenditure needs. Now, I'll take a little bit of a pause here. I'll bring Chris back, and if he can talk about some tax incentives and how SHRED and that fits in to the overall compensation narrative. Over to you, Chris.
Great, thanks, Amir. And I know this question was raised earlier, so it's a good time to get back to it. It's been a while since this was brought up. So generally speaking, the main implication, I think, from a salary versus other forms of compensation comes down to the SHRED program. As a founder, so maybe I'll step back a minute. So for programs such as the SR&ED program, eligible expenditures include labor and contractor expenditures, right? So a lot of people may think that if a founder pays himself as a contractor, then that would be an eligible expenditure for SHRED purposes. But unfortunately, that'd be considered, I don't want to get into too far down the weeds, but that would not be an eligible expenditure for SHRED purposes as if you're paying yourself as a contractor. So if you want to take advantage of the tax credits through SHRED for your own efforts, I guess, in building the business, you want to pay yourself a salary. Now, the amount of that salary is something that can be discussed, but it has to be a T4 salary in order to be eligible for SHRED. Other programs aren't as, I guess, stringent on that requirement. So there is some flexibility for other funding programs, but specifically for the tax credits, it has to be a payroll salary. I think that's about it for that topic, Amir.
Okay, very good. Thanks, Chris. Other incentives that I spent a lot of time over the past year on are the Canada Emergency Wage Subsidy Program, or CEWS program. Also required to have a T4 benefit or a T4 salary issued to employees and founders to be able to access that program. Again, it covered, depending on your business and the amount of lost revenue that you had, the government would cover up to 75% of the salary. So that plus SHRED program was very attractive and very powerful for a number of founders in our area. And so perhaps, not necessarily tilting the favor towards salary, but it's a very tax advantaged form from a corporate perspective of compensation. Some lending requirements, again, if you have found funding from BDC or commercial bank, then they may require a certain amount of cash on hand. They may require a certain amount of assets or a smaller amount of debt in order to meet their requirements. And that may, from a corporate perspective, increase or decrease the amount of compensation that it's allowed to pay. Also, just normal working capital and capital expenditure needs. Again, you do your budgets and your cash flow projections for your organization. You may decide, oh, you know what? We actually have some extra, if such a thing exists, that we can allow a salary or a raise or a bonus to be paid. So those are things to keep in mind as you're thinking all the different hats that you could wear and the different elements that are relevant in the decision-making process. With that, I'm now going to get to the good stuff, or the math, or the tax implications. Get my slides here. So we've gone through the options, we've gone through the practical considerations, we've gone through all the other stuff. Now, again, we get to the good stuff, the tax. And the tax is often one of the dominant considerations when deciding which compensation method to use, because it can be such a big cost. The reason I've left this close to the end is because it's really not hard. It's math and it's arithmetic, and there are very few elements about that. So I wanted to go through all the other elements first and get those in your mind before we ran out of time, which we're not. We're still doing okay for time. So that's where we are. One thing I want to remind people of is in Canada, we've got a system of integration, and that is our uniquely Canadian system. And it assumes, correctly, individuals are at the top of any business structure. You can have any combination of trusts, partnerships, corporations that you want. There's going to be a human at the top of that structure. And so because of that, it tweaks and tunes tax rates so that on a fully distributed basis from whatever layer or whatever organization, it will be about the same if a person earned it directly or you earned it through some other vehicle and paid it out as a salary or dividend. And so we have multiple layers of taxation. It's designed in our system. That's the way it works. It mostly works from an integration and from mathematical and arithmetic perspective. And so I'll illustrate that on the next slide. But again, remember that integration is not perfect. There are ways to optimize it for your own situation, because all integration does is it attempts to minimize the instances of double taxation. And in that effort, it succeeds mostly, but there are times where there are optimal or tax arbitrage opportunities. So on a mathematical basis, here's some tax rates. So for 2021, for an Ontario resident earning more income than $220,000 a year, there is a salary, again, personal tax rate of 53.53%. If there's a regular dividend or a taxable dividend, in order to have a taxable dividend, company has to have profits, pay tax on it. Corporate small business tax rate in Ontario is 12.2%. The corresponding personal tax rate when that dividend is paid to an individual is another 47.74%. So 12.2 plus 47.74. Seems to be a big number. If there is a corporation that is a bigger business, and so it's earning more than, let's say, $500,000 taxable income, it will pay the big business tax rate of 26.5% in Ontario, and then it will pay that eligible dividend. Remember I mentioned that earlier on that other slide with that chart. That tax rate is 39.34% on a personal level. And then if there's a capital gain in the company, it has a level of corporate tax, and then there's a level of personal tax thereafter. There's a handy dandy personal tax calculator I put at the bottom. Again, that's the link to the calculator. They get updated every year with various changes, and they're good for every province. So that's another resource for you. Now, Jordan, we've got another polling question. And the polling question is, which type of compensation is the most tax efficient on a fully distributed basis? Salary, regular dividend, or eligible dividend? Not going to include the capital dividend or CDA, but we're going to do just the first three. And we'll do some math on all of those on the next slide. As the polls are coming in, again, just reiterate, Canada is a multi-layered system. You're always going to have especially in a corporate structure, you're going to have a corporate layer of tax, personal layer of tax. You can't necessarily add up the two boxes on a row and say, well, this total tax rate is smaller, therefore it's more tax efficient. There's some oddities there, but you get the flavor. All right. So looks like our polling is done, and mixed bag, very mixed bag, which is kind of cool and exciting. We've got about 25% voting for salary, 31% voting for regular dividends, and 44% for eligible dividends. Very exciting. Well, without further ado, here's your math. So I've done, again, the three options, left to right, salary, regular dividend, eligible dividend. I started to keep changing my terminology, but I'll articulate which one is which. And so if you earn, and so I've used this example, it assumes that we're dealing with a top rate taxpayer, so someone who earns more than $220,000 in Ontario. And this is what happens when $1,000 or $10,000 works its way through the system. If you have a salary, then the company earns $10,000, let's say, pays that $10,000 as a salary. So now it had income of $10,000, it had a deduction for the salary of $10,000, and that's now paid to the individual. So there's no cash left in the corporation, there's no tax. Person receives the salary at 53.53% tax, and it has 53.53% effective tax rate. End of story. Second column is if you have a regular dividend or a taxable dividend. That is income that is taxed at the small business rate. If you recall, that was 12.2% corporate tax rate. So if that $10,000 is in the company, don't do anything, no salary, so you pay tax. Then you have money left over, you pay the remainder as a dividend, so a taxable dividend, then that tax rate would be 47, and so you pay 47% tax on that, blended. Cash left to the individual, lo and behold, your effective tax rate's higher, 54.12%. Regular dividend, or eligible dividend, so that assumes and requires that the underlying business has paid big business or large corporate tax rate of 26.5%. So same $10,000, pays corporate tax at 26.5%, has residual income, it pays the residual income as a dividend to its shareholders. Personal tax rate of 39%, and lo and behold, the residual is 55.42%. So on a pure arithmetic basis, salary actually is the cheapest form of compensation. Now, again, this assumes one key factor. Well, it makes a number of simplifying assumptions, but the key one is we are paying someone who lives in Ontario and they already earn more than $220,000 per year. So there's some other oddities that I'll go over on the next slide where that key assumption of Ontario resident earning more than $220,000 sort of falls apart, and there are some places where there's an optimization to be had. Jordan, I saw some items pop up in the chat. Would this be a good place to deal with those, or are those questions for later?
They were just thank yous, actually, saying wonderful presentation. So we're okay for questions now, but again, we are coming up on the Q&A period soon, so feel free to put them in there.
Very good. Okay, so here we go. So the tax implications, again, theoretical integration does exist, but there are some oddities. Again, when you have lower rates of income, so under $220,000, then there is an optimization or an arbitrage opportunity that can exist. At lower salaries, the overall effective tax rate of paying a salary will be lower than 53.53%. Those two calculators I gave you early on, use both of them in tandem to find out, well, what is my actual effective tax rate if I were to earn $100,000 in my business, pay a $30,000 salary and a $20,000 dividend? What actually happens? And you can play with them to find out, using the two calculators to find out, well, what works best for you? And that would be a way to optimize your situation just using the available calculators. The thing to know is corporate tax rates are fixed. So $1 of income pays the same amount of tax, but personal incomes are graduated. And so your tax rate starts lower and gets higher. And so there are ways to optimize your situation. Same thing, a dividend tax credit for individuals is fixed, but a personal tax is levied on a graduated basis. So at incomes, let's say under $40,000, $50,000, $60,000, your income tax rate might be very low, but your credit is a fixed amount. And so you may end up in a situation where your effective tax rate is very low, in the under 10% range. And so there are some of these oddities that exist when you play with fixed numbers and variable personal tax rates. Finally, individuals also have non-refundable credits, other deductions, and there's tax planning and tax planning strategies that you can implement that make the actual tax rate lower than the posted rate that I did the math on. So on a pure arithmetic basis, salary wins. So the 25% of folks who went salary have the right answer there on a pure arithmetic and theoretical basis. But actually, again, use those two calculators to find out what's best for you. And my last topic is just the impact on the outside investors. And, investors are very important and they're highly influential on the compensation decision, but there's some elements that you might not have thought about that I put on the slide. Again, will your decision on how much to pay yourself impact outside investors? Yes and no. But investors may have expectations of the sophistication and of the organization, and having regular and fixed compensation models and habits is actually a very positive thing in that regard. All investors, they'll compute their own quality of earnings and their own normalized EBITDA, so earnings before interest, taxes, depreciation, and amortization. So they will calculate that themselves. They won't necessarily use your internally generated compensation to factor into their valuation discussion. They will always adjust out founder compensation. They will often calculate their own value. So they will say, well, what is our calculated EBITDA times a multiple that's appropriate for your industry? And that's the value that they will ascribe to your organization. So if you try to optimize your value, your business value, again, there's two elements to that formula, EBITDA and multiple. And manipulating your EBITDA rarely results in the total value getting higher because your investor will adjust out. They're sophisticated folks and they do this fairly frequently. And so they have models that they use. But showing sophistication and showing compensation and showing that your business is ready and it's scaling and growing, that will increase your multiple and that will increase the overall value. And so I find, having sophistication in your organization, having discipline about regular compensation shows your value to the organization, and it sets expectations post-investment. And so all of those things lead to an overall higher value. So strongly recommend that the hygiene and the overall compensation is done in a manner that recognizes the value of the compensation and or value of the employee, and not to manipulate the EBITDA. Finally, from an investor perspective, the compensation level may be subject to their own internal or external or even regulatory requirements. And so your compensation may be set at one amount, but it's not uncommon for it to be adjusted in some way, shape, or form once you have external investors or angels who may have other opinions and other requirements. So that's what I have there for our formal part of the presentation. Jordan, I turn it over to you for some Q&A, and I'll let you guide this part.
Wonderful. Thank you so much, Amir. We've gotten a couple messages to us directly and in the public chat that was such a wonderful presentation from you and Chris. And we're so thankful that you could join us today. Please, everyone, feel free to either type your question and post it in the chat. If you'd prefer to speak your question aloud, you can raise your hand and I can call on you, or you can just come off mute if you'd like. But maybe we'll give them a couple of minutes if they're typing out their question. I have a question for you though, Amir, based on some conversations that Mickey and I have had with some entrepreneurs over the last few weeks. Your presentation was loaded with a lot of helpful information for somebody maybe feeling a little bit overwhelmed on where to take their first step, if maybe they're an earlier stage entrepreneur that is just ready to start exploring some of this. What would be a good first step that you would recommend for them?
Yeah, great first step. And assuming some steps before have been, well, my business is sort of going, I have my business number active, my cash flow permits payment, and we're just getting to that point of, okay, now what do I do? It would be great to give your accountant a call and say, hey, look, I heard this really cool presentation from EY. They mentioned all these things. I'm thinking it might be good to do a salary. And from there, your accountant could guide you to, okay, well, that's the case. Here are these forms you need to fill out. Here are the things you need to do on Canada Revenue's website, and give it a go and see what happens. And because they give you to the 15th of the month, to the next month, to do any remittances and paperwork, it is quite forgiving in that regard. And that would be a great way to start.
Awesome, thank you. Our first question in the chat here. If a founder pays salary as a contractor, a T4A, will it count as an income? Absolutely, yes.
That is still income, unfortunately, or fortunately, depends on your point of view. But yes, if you pay something, so a management fee or an amount to a contractor on T4A, that will be income. There are very few exceptions to that rule, but generally speaking, yes, it will be income.
Awesome, okay. We don't have a whole lot of questions today. I find that is usually reflective of an amazing presentation that is loaded with a lot of answers already. So I will go into a bit of our wrap up, but we do have time. So if after I'm done speaking, there's questions in the chat box, I will get to those. But really big thank you on behalf of Mickey and I and Innovation Guelph to you, Amir and Chris, for joining us today for our Toolkit Tuesday. If you are an entrepreneur that is a client with Innovation Guelph and you'd like a direct referral to Chris, who is our main contact at EY, please send myself or Mickey an email. Mine is jordan.huntsberger@innovationguelph.ca and Mickey's is mickey.campo@innovationguelph.ca. I'll pop those in the chat after. But you will also be getting an email from me in 1 week's time with the slides and a recording of the presentation after it is processed. That is a couple days longer than our usual turnaround, but we do have our Innovation Expo on Thursday and it's full steam ahead and all hands on deck for that. But you will be getting the follow-up information in next Tuesday. And then you can follow up with me if you'd like a direct referral then. If you're not a client of Innovation Guelph, as this workshop is public facing, you are welcome to have a direct referral to EY still. Please email myself or Mickey with a little bit of context as to who you are, what you're looking for, and what your business is if you have one, and then we can make that connection for you. I have also, Mickey's just put both of our emails in the chat. Thank you very much, Mickey. I've also put an feedback link for our session today. We at IG and EY would very much appreciate your feedback from our session today. There's also an option on that form to suggest topics for future sessions. So we would love if you could fill that out. Just scroll up a little bit in the chat and that is there. And I'm still just trying to see if there's any questions, but I think we've pretty much covered everything. And we might wrap up a little bit early. If you do have questions that pop up later that you forgot to ask or didn't come up, just send me an email and we'll get them answered for you. It's not a big deal. And yeah, so click on that feedback link, open that up and give us your thoughts on our session today. But other than that, I think we are ready to wrap up. Just checking the chat box now. I think so. So I'm just going to share my screen again at the end. So thank you very much, everybody, for coming. Thank you again to our sponsors that make our Toolkit Tuesday sessions every month possible. Along the bottom there, big thank you to EY. Big thank you to our ASL interpreters, Kevin and Shannon today. They did a fantastic job making our session more accessible. They will be included on our recording on YouTube. So that's awesome and lovely as well. So I'm wondering if Chris and Amir, did you want to say anything to wrap up?
Amir, anything from you?
Nothing for me. That was great. Thank you so much for having us.
Yes, nothing from me either. And thank you, Jordan and Mickey, and thanks for everybody for attending.
Okay, awesome. Well, if that's everything, I'm available via email if anyone has any questions, but we will wrap up for the day. So thank you so much, everyone, for coming.
Thank you.